Welcome to the T14B video lecture. This is where it's going to start to feel more like tax and less like economics. In this video, we're going to march through the federal income tax return for individuals and get a sense of how income taxes are calculated and reported. Your book describes the individual income tax computation as a four-step process. Total income, then adjusted gross income, deductions and exemptions. I'm going to add two additional steps because, well, we're overachievers. We're going to also calculate tax and then apply credits and payments. So this slide presents the top part of Form 1040. This is the form typically used by individual taxpayers to report income and deductions and ultimately tax liability. The top portion is mostly taxpayer information, but also includes filing status, which we covered, of course, in the previous video. The bottom part of this section is where dependents are listed. Dependents play a role in a number of tax items, for example, filing status, single versus head of household, but also including something called exemptions, which we're going to cover later in the video, but I want to make sure we note that those have been repealed under the new tax law. If we continue our way down the 1040, the next section is intended to capture sources of income. So this is the textbook section for step number 1, total income. You can see wages on line 7, interest and dividends are on lines 8 and 9, business incomes reported on line 12, capital gains on lucky number 13, and other income items. Ultimately, these total up on line 22 as total income. So the next section of the Form 1040, continuing down the page, provides for a certain number of deductions in arriving at what is known as adjusted gross income. So this is step 2. Adjusted gross income, or AGI, is a little bit of a magical tax subtotal in that a number of other key provisions use AGI as a yardstick to determine whether a taxpayer can or cannot take a deduction. If you recall back when we discussed fairness and ability to pay, we considered a deduction for a casualty loss, and we noted that the tax law used a floor of 10% of AGI to determine whether or not the casualty was large enough to warrant a deduction. This is the very same AGI we talked about then. The taxable income needs a subtotal like AGI in order to avoid circular computations. For example, if the casualty loss were limited to 10% of taxable income, then taxable income would be dependent on the casualty loss deduction, which is dependent on taxable income, which is dependent on the casualty loss deduction, etc., etc. As I mentioned, there are a small number of items that are deductible to get to AGI. These are often called for AGI, or sometimes referred to as above the line, with AGI being the so-called line. These include a deduction for contributions to an individual retirement account, 1/2 of your self-employment taxes, deduction for alimony, which by the way was repealed for new divorces after the end of 2018, and student loan interest. These are called for AGI deductions because in theory, but not always in practice, these are not sensitive to the level of income, therefore not really sensitive to the ability to pay. The next section of the Form 1040 actually starts on page 2 and really packs quite a wallop. There's a lot going on. Inside this section are the standard deduction or itemized deductions, the deduction for exemptions, again at least in 2017, the computation of taxable income, that's on line 43, and finally the computation of tax. This is step 3 and 4, and believe it or not also includes parts of my steps 5 and 6. Let's start with the standard deduction or itemized deductions, which we cover in more detail in the next video, so you know they must be important. First off, be aware, these are not all the deductions a taxpayer can take. In fact, deductions related to business income or rental income are taken before this point and are reflected really in step 1 under total income. Recall that we said business income was reported on line 12, for example. Well, that's already net of all business expenses. Itemized deductions are a narrow set of deductions that are personal in nature, but are related to the ability to pay. So rather than say more now, I'll ask you to pretty much just hold your breath on itemized deductions till the next video. But for taxpayers with few or no itemized deductions, the standard deduction is available. So the tax law permits you to take the greater of these two amounts. So next is personal exemptions. And again, up through 2017, the tax law permitted an exemption deduction for each taxpayer, the spouse, if there was one, and any dependents, for example, like children. The exemption amount was like a free deduction, free is in air quotes, that was available to just about everyone and helps create a 0% tax bracket. So for example, if a taxpayer's taxable wages were only $4,000 in 2017, the personal exemption would eliminate any taxable income. The standard deduction also works in a similar way. Oh, wait. I said we were going to wait to talk about that. My bad. Okay. So a note, again, of some importance is that the new tax law eliminated the personal exemption deduction in lieu of a larger standard deduction. Oops, I said it again. Okay, patience. Collectively, these deductions, the personal exemptions and, well, the deductions that shall no longer be named, are known as from AGI deductions because they're below the line. Okay, to summarize what we've covered so far, gross income minus 4 AGI deductions brings us to AGI. AGI less from AGI deductions brings us to taxable income. Since that is our tax base, we use that amount to multiply by the rate to get our tax liability. Technically, the IRS requires we use a special tax table for taxpayers with taxable income under $100,000, although we're generally going to use those tax rate schedules that we've used over and over again. Okay, the overview is almost done, but I want to back up a little bit and talk about a few more items within this section. So after calculating taxes on line 44, Form 1040 continues on for kind of a healthy number of lines. Also included are credits. So credits shouldn't be confused with deductions. Deductions lower taxable income, and thus indirectly lower taxes by lowering the tax base. Credits, on the other hand, lower taxes directly. They represent a dollar-for-dollar reduction in tax liability. We're going to talk about credits in more detail in a couple of videos, so just remember, this is just an overview. All right, now let's skip back forward again. So the last section is what I like to describe as the settling up section. So the U.S. income tax does not permit taxpayers to wait until they file the tax return to make tax payment. So for employees, for example, we know from our discussion of convenience that income taxes are withheld from employees' pay by their employer and paid over to the IRS. For self-employed taxpayers, they're required to make estimated income tax payments during the year. Whether through withholding or estimated payments, the amount paid almost never matches exactly the final tax liability computed when you file the tax return. As a result, there's a settling up process. If too much was paid in for taxes, then the taxpayer is going to be entitled to a refund. If too little has been paid in taxes, then the taxpayer is going to owe money and is going to be required to pay with the tax return. If that amount is fairly large, the IRS is going to assess penalties and interest for failing to pay your taxes on time. This brings us to the end of our overview of individual income taxes. We're certainly going to dig in a little deeper next with coverage of deductions, exemptions, tax rates, and credits in the next 4 videos. So thanks for watching.